Hey, do you want to know what hurts business buyers the most when analyzing deals? It's not knowing how to properly analyze and understand financial statements. Now, I've done videos where I show you how to actually do the deal analysis, the debt service coverage ratio, and the SDE and everything else. But this time I'm going to teach you actually what to look for when you're looking at a P&L and a balance sheet from an accountant's perspective, and how to really understand the language of business, which is accounting. Let's get to it. Hey everybody, welcome to my channel. I am your host, Leo Landaverde, business broker and commercial lender, helping you buy and scale a profitable business. Are you a small business owner looking to increase your wealth or expand by buying a profitable business, or a W-2 employee sick and tired of the rat race wanting to get out by buying a profitable business? Then you are in the right place. Please subscribe to my channel. Don't forget to hit the bell, and you'll be notified every Thursday when new content comes out. Hey, so I wanted to take the time to kind of coach you along on some of the things that I look at when I'm looking at the P&L and the balance sheets. Now, what this is these are KPIs, key performance indicators. When we're looking at a multi-year analysis, or what we call the spread of financials or tax returns. Now, I'm just using two years as an example, 2024 and 23, and I'm going to walk you through the different kind of KPIs that I look at when analyzing businesses. So first and foremost, you got the revenue, right? The revenue, and what I've done I basically just highlighted just really the high points of the P&L and the balance sheet, and see how they basically interact with each other. So let's take it from the top. So your revenue, right? When you're looking when you're looking at revenue, and it's important to understand the revenue trending as it goes from month over month, quarter over quarter, and year over year. So if you're looking at a set of financials across multiple years, if the revenue went from 5 million to 6 million, which means an increase of 20% year over year, that's great. But why, right? It's good that it went up, but remember, you got to question everything, because what you're doing is really, as a master mechanic, you're trying to understand how this engine works for this business you're trying to buy. And the more you know about the industry, the better off you'll be understanding the nuances on the variability of the different numbers in the financials. So if we went from 5 to 6 million, great. And it was a nice spread with no customer concentrations, and the business has no customer concentration of any client over customer over 10%, great. Now, but if this business went up because it was a sort of a one-off type of deal that produced $1 million worth of revenue, one customer, which means that customer concentration went to 20%, and it's not going to happen again. Now, I'm not really going to give them credit for the growth, because there's not normalized growth. There's a one-off growth. So when I'm looking at the business valuation, I'm going to really be mindful of why the revenue is going or decreasing. Now, if the revenue is trending up very, very nicely, of course, we like that, so long as there's no customer or vendor concentration issues or other issues that we can foresee before we get into due diligence. The next is the cost of sales. So I would say if you're in manufacturing, if you are in the construction and some of the trades, you may have some, actually, definitely most of the trades will have cost of goods sold, right? So what makes cost of goods sold? It's anything that is pertaining to revenue. So the best way to separate the expenses of cost of sales and the operating expenses, which we call OPEX, is the variability of it. So if it is variable and it goes up and down with revenue, chances are it's variable and it's cost of goods. If it is fairly fixed, i.e. your general administrative expenses, your marketing, your software, your rent, your legal fees, your accounting fees, and all, your software subscriptions and all those things, they tend to be more fixed. So they will be at the operating expense. So what I'm looking for is, again, the variability of year over year. So there was a 66% increase from 23 to 24 in this sort of illustrative, sort of a made up example. And the gross profit went from 3.8 to 4 million. So something happened in 24 that made it a significant increase in year over year of 66%. While the revenue went up 20%, the cost of goods went up by 66%. Now, it's being impacted by tariffs. Where is that added expense coming from? Because as you increase the cost, it compresses the gross profit. the gross profit in this case went from 3.8 to 4 million. Now, you notice now that it was just a 5% after that $6 million worth of revenue, which is a 20% increase of one. Even though we had $1 million more revenue than we did in the prior year, our gross profit only increased 5%, 5.26% to be exact. So that's something for you to consider. Your net operating profit, your operating expense was 2 million and then 2.5. Your net operating expense actually went down. So stuff is happening in 24. So, even though we went up by $1 million, we went down by $200,000. So where is that? Is that a red flag, right? Is that a sign of things to come? When you're looking at those things, you want to be very mindful of those things when you're analyzing. That's basically what's under the hood, right? This is just understanding what makes a business grow, the engine. Now, that's the profit and loss. Now, let's talk about the balance sheet. The balance sheet is the most important financial statement of a business because it's the only permanent statement of them all. So your P&L changes period over period, which is month over, year over year, quarter over quarter. It will change. But the balance sheet is permanent, which means that the ratios that are derived, all of these ratios, most of them come from the balance sheet, are going to be determining the health of the business. And the formula for the balance sheet is assets equals liability plus equity, right? So what are some of the assets? Assets are divided into current assets and fixed assets or non-current assets. Current assets is anything that is that can be liquidated and turned into cash within 12 months. And same with the short-term liabilities, anything that is due and payable within 12 months. So once you know those two pieces, it's going to it's going to help us with the current ratio. And the most important thing that I talk about with buying a business, working capital. So let's just say that in this particular example, your cash went from $500,000 to 1.2 million. It looks great, right? Other current assets stayed the same. Your accounts receivable went down from 450 to 100,000. So it at least appears on paper that this is very good, right? Your fixed assets are $1.25 million, so went up.
Are you stuck? You don't know what to do? Are you trying to buy a business but don't know what the next step is? Should you get pre-qualified with an SBA lender? When should you prepare your personal financial statement? How long your proof of funds needs to be sitting on the bank accounts? Can you use a HELOC? What about licensing, etc.? We would love to help you. And I'm sure you have a lot of questions and we have the answers for you. Please book a call with a member of our team. Just drop us a comment below and send me an email. My email address will be up here and down below as well, because we want to help you. Even if you don't get to work with us, I think we can give you some actionable advice on how to buy a profitable business. We've done it many, many times inside of our group. Reach out to us.
Your non-current assets are $1.25 million, which is your fixed assets. So your total assets is $2 million, 2.5. It was an increase of 33% on the year over year. Now, your liabilities here stay fairly consistent. Your accounts payable went up by 11%, or 25,000. Your other current liabilities went up a little bit. Your long-term debt stays the same. Your current liabilities just went up by 16%. Now your long-term debt actually went down. You have other current liabilities. You could have an idle loan sitting here, which is those that given during COVID. Total non-current liabilities or longer-term liabilities, 625 went down to 600, so a 4% increase. Great. Your total liabilities went from 925 to 950, so a 2.7 increase. So while your total assets went up by 32%, your current total liabilities went up by 2.7. That's also far so good. Your return on equity, retained earnings are 1.8, and current earnings are 1.5. Total equity of 3.3. All sounds good. Now, let me tell you what that all means. So when I'm looking at these things and I'm looking at a business, the first thing that I look at is what is the current ratio, which is the working capital expressed as a ratio. Anything 2 or better. Some banks will say anything 1.5 to 1 is good. The more the merrier. So when looking at 2 to 1, I'm saying I would like a business to have at least 2 times the net your current assets over your current liabilities. So in this particular case, the formula illustrates $1.5 million divided by 350,000. Now you have 4.29 times the amount of current assets that you do with current liabilities. That's an excellent condition. That is awesome. Now, if it continues that trend over multiple years, it's even better. Quick ratio is really a ratio that we don't really look at, which is it's another health of your cash equivalents over current liabilities. The year-over-year revenue growth, we already established that we looked at the gross profit growth. We established that. Now, the debt service coverage ratio cannot be discerned from looking at this analysis, because what you need the spread, which is what we teach, the multi-year cash flow spread over the debt service, that's beyond the scope of this training. But the working capital is really what I want to highlight. So what is working capital? Let me show you by the formula. Working capital is your current assets minus your current liabilities expressed in terms of dollars. The higher, the better. Now, if you're buying the stock of a business, you will want to ask for the working capital, but the working capital is the average trailing working capital as defined in a stock purchase agreement, which could be over 12 months, over 24 months, which is the difference between your current assets. Essentially is how much cash do you need to run the business and be healthy, so you can have your immediate obligations, especially in the G&A, general administrative expenses, your burn rate. How much cash do you need to be able to be healthy? And that delta between your cash and AR and other current assets minus your AP and your payroll liabilities, that's what makes a healthy business. Now, in this particular example, we have working capital of 1.5, not 1,150,000. Now, I'm not telling you what industry this set of financials come from. It could be any industry, but I tell you that there are sort of mile markers or indicators across multiple. There are research that we do and we teach, and where to find that research, what optimal working capital is across multiple industries. So you need to know that, and also you need to calculate it. One of the ways that you do that is when you're in due diligence, but you cannot figure out what the working capital is. When you're looking at a business, you have to, before you make an offer. Once you make an offer and the offer is fully executed, assuming that you took the business off the market and you're actually really looking under the hood, you want to ask for the P&Ls and balance sheets by month across multiple fiscal years if possible. Sometimes it's not going to be available. Not all business owners who are selling the business are savvy to keep all that information that they're going to need. Some of them change softwares. As one of my clients, he had a few years with one particular software, moved to another software. So that gap sometimes, and you're not able to extract those P&Ls and balance sheets by month. So, but one thing is sure, and in a stock purchase agreement, we're going to calculate the working capital that needs to stay on the business, which on average, it can be anywhere from as little as $25,000, depending on the purchase price, in the size of the revenue and net profit, etc. It could be as high as 300,000. I never seen it over 300,000. So let's just say, for conversation's sake, that let's say it was 150,000 for easy math. Say the working capital needs for this business for the first month that you take over, so you can meet your payroll, pay your rent, and all your SG&A. It would be 150,000. So technically, that means that out of that $1.2 million sitting on the bank account and the 100,000 receivable, assuming this was, if you were buying that business and you were closing in the first couple of weeks of, the month of January, assuming this fiscal year ends 12/31, then the seller would be able and legally allowed to extricate and remove that cash from the bank account, which belongs to the seller, which is that the excess working capital, and they will leave behind the working capital. Now, 3 buckets of cash that you need when you're buying a business. You're going to need your equity injection. You're going to need your post-closing liquidity, and you're going to need working capital, right? Those 3. Now, people ask me in the YouTube channel all the time, what can a guy like me do to buy a business with no money down? There are ways that you can do that, but it's just increasingly harder. There was some seismic change in the SOPs for the SBAs that are just rolling out on June 1st, 2025. There was announced a couple of weeks ago, and there's a couple of material things. And if you want to know more about it, we talk about it in a group. I have SBA national lenders come and talk to our group at least once a month. We have one of those top tier lenders are coming to actually talk to us about what the major changes are. But that doesn't really matter at this point. But for the sake of conversation, is you need really to figure out the health of the business, and these are the indicators. These are the KPIs. Just to recap, you want to know the year-over-year revenue growth, the gross profit growth. You want to know definitely the debt service coverage ratio, the working capital, and the behavior and the changes year over year, your net profit margin, your gross profit margin, and other things. Now, these are more advanced, your accounts payable days, accounts receivable days and account payable days, which means how long it takes for the business, for a business basically to collect its cash or pay its debts. And you can play with the different variables. For instance, let's say our cash and equivalents when it was 800,000 instead of 500,000. Notice that it's actually 800,000. So notice that our current ratio went down to 3.14 and our working capital went down to 750. Went down is it's actually a whole lot of cash right there. But just to show you that those numbers change, right, as you change the variable. So this is a great tool. I'd be happy to provide it to you if you want it. But thank you so much for watching. I hope this was helpful to you guys.
Do you want some free tools? Well, we got them. For a limited time, we're giving away our Deal Analyzer 2.0 and our Business Buyers Checklist. The Deal Analyzer 2.0 will allow you to calculate the most important thing when looking at business. What is the debt service coverage ratio or the cash flow over debt service on any business? And how to ascertain a kind of a ballpark valuation. It's not as dialed in as some of the other tools that we have, but it's something enough to get you going. It's a free tool for being a member of my community. And the buyer's checklist is basically a tool that allows you, it's basically a punch list that you go through on everything you need to keep in mind as you're going through every stage of the business buying process. Those are yours to have. Just click on the links below.